All right, good morning, everyone. Welcome to the final edition of our 25-year family breakfast, virtual breakfast series. The only breakfast series that doesn't provide breakfast. We're very proud of that, and we're very appreciative to have all of you here with us. Thanks for joining. We are recording this morning, which is different and unique than what we normally do, but as you'll see as we go here, it's because we're really honored to have McKinsey's leads on family business with us today. They're going to be sharing some of their research, and so we want to make that available to our families after this. So just a heads up that we are recording. You can still ask questions anonymously. You know, if you don't want your father-in-law to know what you're asking about, you can send a text message to Jane. She'll provide links to that and et cetera in the chat. And so with that, I want to get us started. Again, I said this is our last session for the series for this year. We're going to be using the summer to plan next year. We've got things coming together for our conference in the fall. We'll be starting to put some information out about that and the date and our host and our location here in the next week or two. And some of our speakers for next year. I will tell you that just as a sneak, we are going to be kicking off the breakfast series for next year with the Von Mauer family, the department store chain based here in Iowa. And Jim Von Mauer will be sharing their family story of where they've come from to get to where they are now in an incredibly competitive marketplace. And so with that said, I just wanted to introduce Martin Roll, who's a senior advisor with McKinsey, and Acha Lege, who's the head and chair of the African practice for McKinsey. I'm so delighted to have you guys on today. I first read this research back last fall. It was a big deal when it dropped in our little industry of family business. It was a huge deal to me because I've always been a very big follower of McKinsey and respectful of their work. My old firm hired McKinsey to do some consulting work. It really went well for us when we had them in. And so I'm just so grateful that you guys were able to join us today. And with that, I'll let you maybe introduce yourselves a little bit further and get into things here in terms of your research. And I'm going to drop a link into the chat that kind of gets you to where you can find some of their initial research. So Martin, I'll let you take over. Thank you.
Yeah, I'm a senior advisor with, first of all, Dan and team, thanks for inviting me. Happy to be here. Senior advisor with McKinsey, focusing on family businesses and family offices, working very closely with Acha and all our colleagues worldwide. Super passionate about family firms. I'll get back to stewardship later in the second part of this. So back to you, Acha.
Yeah, and good morning, everybody. Good afternoon I'm in Johannesburg today. My name is Acha Leke. I'm a senior partner with McKinsey. I've been in McKinsey 26 years. I chair our Africa practice. I'm also on our global board. But I think what's relevant here is I actually, over the last 18 months, I've had the pleasure of leading our family business practice. So we used to have a practice that was quite vibrant, and then eventually it fizzled. And so last 2 years, we said, look, let's revive it with an aspiration to be, the value creation and impact partner of families globally. So that's what we aspire to do. And we said, look, if that's what we want to do, then we need to first understand how family businesses create value, right? Hence this research we did. And what we thought we would do today is share some of the findings of the research, and then we can have a conversation around it. And then Martin will share some of his latest thinking on stewardship, right, which is also important in terms of, in addition to sort of making sure you make the most out of the business itself. And so we said, let's really try to understand how the best performing family businesses create value. That was really what we set out to do. And from all the research we saw and what was written out there, everybody knew family businesses create more value or perform better than family businesses. But we didn't think people had gone to the crux of why. Why is that? And so that's what we're trying to get to here. So maybe let me just get going on the next page, Martin. You'll see first, as some context, I guess you're all part of a family businesses. There we go. FOBs, as we know, play an outsized role, right? Whether it's from a GDP perspective, whether it's from an employment perspective. I sit in Africa, we see, it's even a much bigger role in many of our emerging markets, right? Whether it's in Latin America, whether it's in Southeast Asia, whether it's in the Middle East or here. But even in the US, and you guys, I think most of you are based in the US, they play a very, very big role. And the important pillars of the economy in these environments. Now, on the next page, we'll see. So that's what they do. What we said, this is what we set out to do and what we did. We said, let's go and study these. So we studied in depth 600 family businesses, publicly listed, right? So we can get all of the financial data. And then we benchmarked that against 600 publicly listed non-family businesses, right? And then we went and surveyed another 600, and these were primarily private family businesses. And then we did about 20 interviews as well, right? So it's quite a rich data set of sort of call it 2,000 companies that we analyze. And this range from, let's stay on that page, from, small companies, revenues called 150 million to, very large, hundreds of billions of dollars. This was across 75 countries, across all regions in the world, across sectors and years of operation, right? So it's really rich data set. Now, what we said, okay, let's start with, how are we going to measure value, or how these family businesses create value, right? And you'll see us talk about, the spread, which is, how much more you could have made, over, any if you had invested the money, right? And what does that then translate to into actual value creation, actual dollars of impact, right? So those are the two measures you'll see us refer to in this document. Now, let's get into the sort of the findings, right? One is, as I think you all well know, family businesses outperform non-FOBs. That's very clear. And what we found was it's across all the different metrics. So if you just look at a total return to shareholders, right, performance on the stock market, much higher. If you then get to, sort of value creation, it's also 70% higher. If you look at the spread, it's 33% higher. So on any of these metrics, family businesses outperform, right? And we'll now get into the why, right? But that's one. Now, the question is, how do they outperform? And this is where we started to get into some interesting findings. And this is what we'd love to, again, test with you and see how relevant it is. And by the way, we've had this conversation with, hundreds of clients around the world. So first, as you start as a family business, what you find is, FOBs tend to outperform by being better investors, right? If you look at sort of the returns on the investment, on the dollar spent, is higher, because you're very good at spotting opportunities, making quick decisions on going after it and going after that opportunity. So, early businesses, FOBs are better investors. Over time, they become better operators, right? So now you've been running the business for a while. You have a relationship with all the suppliers. You know exactly how to run the business. Maybe your family is involved as well. You have employees who've been there a long time, and you guys really have honed the skills of how to run the business. So you typically start as better investors, and eventually you migrate into being better operators of the business, right? That's generally how family businesses outperform. Then we looked at, let's also look at sort of the age of the family businesses, right? And it was interesting to say, we call it first generation, right? The first 25 years of the family business. Typically, if you look at just revenue growth, these companies grew twice as fast as non-family businesses, right? So the first, on for the first generation. That then said, the next 25 years, what you find is the difference is not as pronounced, right? It is still higher, but it's definitely not the 2x you had in the first. And the big discussion we're having here, and I'd love to hear your thoughts as well. And by the way, happy to take questions along the way. I don't know how you want to structure. I'm happy to take questions along the way. The big discussion we're having here, the question we have is it that, the next generation, isn't as entrepreneurial as, the initial, right? The patriarch or matriarch who started the business? Is that what it is? Is it that the next generation is focused primarily now on value preservation than value creation, right? But there's something here which says over time, from a revenue growth perspective, it definitely slows down and it starts to mirror that of non-family businesses. Next page, Martin. So then what we then said, okay, fine. Now let's look at, again, we had this group of businesses, and let's bucket them into 5 quintiles of performance. So on the left is the worst performing companies. This is a metric we call economic profit. It's a metric that we use as McKinsey, which is your return above your invested capital, right? How much more profit you're making above your invested capital. So on the left are the worst performing. On the right are the best performing companies. In each of these quadrants, you see two bars. The left bar, which is the light gray bar, is FOBs, and the blue bar is non-FOBs, right? So the first thing you see is across all of these quintiles, FOBs always outperform non-FOBs. So where they're doing better, if you look at the third, fourth, and fifth quintile, the FOBs actually do better, right? So their performance, they create more value than NFOBs. In the first two on the left, where they're actually losing money, FOBs lose less money than non-FOB, right? So across the board, you tend to perform better. Now, what's more interesting is if you look at, sort of the right, the top performing FOBs outperform the top performing non-FOBs by even more, right? So there's 1.1% point there of difference in outperformance between the top FOBs and non-FOBs versus 0.4 for the first 3 quintiles, right? So it's interesting. So we say FOBs outperform in general, but then the real best ones do even much better than the best non-FOBs. And so we said, look, you know what? There's something about this group of companies, and let's go and study them and see what we can learn from them. Right? And so we went and identified them. There are about 124 of them. We call them outperformers, right? And again, here, widespread. So you don't have to be, massive to be outperformers. You can also outperform as a small company. You don't, there's some only who've been in business only for 10 years, and the others have been here for many, many, many generations. They're across sectors, across regions, right? But those are not the 124 we studied. Before I get into, now with the results, so maybe let me just pause here and see if there are any, I don't know what you think, Dan. Happy to take any questions, comments, reactions at this point in time.
Oh yeah, I appreciate it. I appreciate where you're going here. We're kind of getting out of the data research into the what did we find for those outperformers. So basically that's where you're funneling us down to now is of those that outperformed, what did they do collectively that we can pull some summary data from here, right? Some best practice data from versus those non-FOBs. And I think here later on, we'll get to maybe a little bit of a point that Martin will make about size of firm, and if my firm is a $200 million firm versus a $2 billion firm, does this stuff still apply to me? And I think we're going to get into that. And so I'm just going to hold off on any other questions till we get a little farther along here.
Okay. So should I just continue?
Yeah, please.
Okay. So now let's get into, what we call it sort of, the secret sauce, the value creation formula.
Yep.
And the 9 elements, right? There are 4 which we call, these are mindsets. And it's what you find, these mindsets, all FOBs typically have this mindset. We'll go through them, right? But for the best performing, these are so much more pronounced, right? We'll talk a bit about that. And then there are a number of strategic actions, and this really differentiates the best performing FOBs versus the others, right? So on the first one, let's stay on this page, on the previous page. The first one on profits beyond purpose beyond profits. I'm sure you'll say the same. It's all about what is my purpose? Very much purpose driven, and that's typically most FOBs have that. It's not just about making money; it's also making a difference. What we found is that the best performing were able to really embed that purpose across the organization. So even if they had 20,000 people, we've seen some guys that had, a large number of employees, the employees really understood it and they lived by that, right? They lived by the fact that we're here to make a difference. Yes, of course, you need to make money for our shareholders. We're here to make a difference. So it wasn't just the family, it wasn't just at the top, right? It was really, really embedded within the entire organization. So the question for you is, how much, if that's sort of, your mantra as well, how much of that have you been really able to embed? And if we go talk to somebody at the front line, what are they going to say they're here to do, right? So really, I think that's the question there. On the long-term perspective, you'll see me the next page then where we say, we always say, FOBs initially, I was like, maybe I would not be surprised if the family is trying to take money out of the business, right? So they're trying to take money out because, they're trying to, the things they want to do with that. What we found with dividend yields for FOBs are lower than for non-FOBs, right? And so what you do is you actually tend to reinvest in the business, right? Because you're thinking not for the next 5 years, 10 years, thinking the next generation.
Mm-hmm.
So you think much, much longer term, and you see the dividend yields are lower. And actually for the best performing FOBs, dividend yields are even lower than that. They're even lower, right? So you're really spending time to reinvest in the business and make the most out of it, as opposed to taking money out. So, but again, like I said, all FOBs, typically have this long-term perspective. That's why they're family businesses, right?
Yeah, I feel like that makes sense. I mean, that we would see that we would see a lower yield because of that, the less pressure for near-term results, the less pressure for shareholder return, et cetera, that exists in an FOB environment. So, I mean, I feel like this is confirming to that. And then I'm guessing that bears itself out in longer term gains and longer term performance.
Exactly. And that speaks to the next point, right? Which is, cautious financial stance. And I think we have a page on that, if I'm not mistaken. Yes, here. Which if you look at just, your debt to equity, right?
Yep.
So typically, in non-FOBs, FOBs are much more cautious, right? When it comes to, taking on debt. And actually the best performing ones are even more cautious, right? Now they do it, right? It's not like they don't do it at all, right? They do it, but they're very thoughtful about how they do it, right? And that's why what happens, we didn't have the chart here, but, when things are tough, like in COVID times, for example, FOBs survived a lot more than non-FOBs, right? Because they had that cushion. They were not as exposed in those times. But on the flip side, what then happens is when things start to pick up, FOBs still tend to be a bit too cautious, right? So the question, again, for you here is when we think this, caution and make sure, you have sort of a base to survive is very important. But when there's, when things are starting to be on the upswing, how quickly are you to capture those opportunities? We found that FOBs tend to stay a bit too cautious for too long. And so what is it going to take for you to really get out of that mindset and go aggressively after the opportunities as you start to recover? Would be the question that would have for you here. But that's on the financial stance. The final point on that one was decision making. And you'll know this, right? So your family businesses typically, even if you have boards, we said it's not necessarily quick, but it's efficient, right? So in general, sometimes it's quick, right? One person makes a decision, the dad decided or the mom decides we go here. That's where we're going. I just had a meeting with a family in Nigeria yesterday, and it was very clear. The son was like, when we decide, I go to dad and we make a decision and boom, we go. But in other cases, it's not as quick, but, there's a process to say, okay, fine, we need to consult, but here's a process. And then boom, we make the decision. So because it's much more an efficient decision-making process. Now, like I said, these mindsets are prevalent, I'm sure, across all FOBs. The question is really, how embedded is it within the entire organization from a mindset perspective?
Sure.
Any question on mindsets before I move to the strategic actions?
How are we able to kind of pull research that maybe, on that efficient decision making, does that become a little more of a subjective type of research data point when you're looking at publicly traded firms? How do you? Because I would think that just theoretically or whatever, we would assume that family-owned companies would have much more streamlined decision making, far fewer people in leadership roles, making decisions, fewer committees and whatever, just conversations happen quicker when there's fewer people at the top that can make the decisions on behalf of ownership because they are ownership. And I'm just, how do you pull that on the public, on the non-family side?
Yeah, so what we did here, this was through surveys, right? So some of this, so some of the data we got through just financial data and crunching it. Like I
Okay,
said, we actually surveyed 600 companies.
okay, okay.
That's where we got some of the richness of the data around, how quick is your decision making, how many people are involved in making these,
Yep.
sort of
Okay,
important decisions, what kind of structures do you have in place, and we'll come back to that to make these decisions. So we got that through surveys.
okay. Thanks, Acha.
All right. Then the next is strategic action, and this is really what differentiates the best performing FOBs, right? As you start to think about your businesses, I'll just encourage you to think through, how much of these do you employ today, or what year do you need to sort of move the needle on? So on diversified portfolio, on the next page, you'll see this, I think is, for me was actually quite an eye-opening finding, which is, the bottom line here is the outperformers and the top is the other FOBs, right? And what we have here is the percentage of the business that came from non-core activities, right? So not what they started with, right? So the best performing of FOBs today have 40% of their business, 40% of them have 50% of the business, more than 50% of the revenues from non-core activities versus 7% of other FOBs. That's the 6x difference, right? So the best performing FOBs are always on the lookout for how do I diversify? And it's not just what do I buy, it's also what do I exit, right? So what's my portfolio looking like? What are the trends in this sector I'm in? Am I still the best owner for this? If not, how do I exit, right? And then how do I redeploy that capital, and where do I redeploy that capital? And so, many of the clients we serve here, this is the conversation we're having with them to say, how quickly are you at identifying this, right? Or how stable is your business model? And by the way, it doesn't have to be a new business. It could be I'm going to a new geography, right? It could be I'm launching, a set of new products, right? But you have to constantly be reinventing yourselves. At least the best performing FOBs are constantly reinventing themselves, and that is one of the the drivers of the outperformance, right? If you look on the right, 70% of them performers also say that they're prioritizing expansion beyond the core industry over the next 5 years. So they're doing it now, and they're going to do it again, right? On the next page, we'll talk about how they do it, and then we're happy to take some questions. Where M&A is a lever that you see our performers, about 60% of them said they've completed a deal. We've done a lot of research as McKinsey in terms of M&A, because, and I know many families we talked to, we just had with Martin, we had 20 next gens for 2 days in Zurich, and many of them are very cautious about M&A. Is this something we should do? Is this something we shouldn't do? What we found is the best companies are the ones that do what we call programmatic M&A. It's not just do one big deal every 10 years, right? Because then you have not learned how to integrate these companies, how to do a proper, post-merger integration. They do more programmatic. So they do, mid-sized deals, a few mid-sized deals every 2-3 years, right? So then they learn how to do deals, how to assess them, how to integrate them. Those are the best performers. But the point of diversification here is very clear, right? If you want to be a best performing FOB, you really need to think about, how diversified your business is.
Okay, and actually, I had one question that came in about that, as far as, it seems like that would contrast a little bit with, that's not what I would have thought at all. I would have thought they would stick to their knitting and just stay niched or whatever. But when you think about, we've just talked about how they're typically conservative, more so with their financial decision making. How does that overlay with what I would call also innovative and strategically on their game, for lack of a better word? How do you kind of draw things out of those two things that might seem a little mismatched, at least in my mind?
So at least when you say diversification, it's not necessarily get into a new industry, right?
Okay.
It could be this is a new region that I'm not penetrated in, right?
Yep.
It could be, I sell this set of, fast moving consumer good products, and how do I then, expand into adjacencies, right? And so it's not necessarily, oh, now I'm getting into I was a car, I don't know, a car tire manufacturer, and now I'm going to go into something completely different.
Sure.
Right? But it is, and it doesn't mean that you're not going to be successful if you don't just do one thing. What we found though is that the ones who are most successful, they can do, and it comes back, you'll see some of the other points of identifying where is the next big growth opportunity going to come from, and how do I then go after it, right? And it could, like I say, it could be from a geographic expansion, it could be a channel expansion, it could be a product expansion, right? Or it could be a complete new industry, right? But it's about doing something beyond what you're currently doing.
I don't know if you can answer this or not, but are there things that you heard in your interviews or just with your expansive work in this space that maybe set families up differently is in terms of how they maybe attack the issue of strategic planning and growth within their processes as a firm? Is there things that they do a little differently or ways that or does it just really come down to the fact that they can make decisions quicker with fewer people and thus politics and other kinds of issues don't bog things down? Or is that's too simple of a way to explain the difference?
No, there is, and actually it's actually a good segue to the next point, which is one of the big, if you get into that, on its resource allocation. So yes, everybody has a strategic planning process, right? But what we found here, and you can go to the next page, March, on resource allocation, it's about, how do you identify opportunities and how do you put resources behind that? Because generally what happens is you have a budget, right? And then next year's budget, you add a bit here, you add a bit there, and that's next year's budget, right? The best, but what you see here is the question we ask is how much of, what percent of companies are able to shift more than a third of the capital between businesses over 5 years, right? So that's a fundamental shift to say, and if you're shifting, that means you're taking it away from some businesses that potentially need it into other areas that, will provide you a higher return. And you can see the outperformers are 3 times more likely to do that, right? So 60% of them actually shifted capital, a third of the capital or more over the 5 years, versus only 20% of the outperformers. And this is one of the levers that makes a difference, right? Are you sticking to, I'm in this business because I've been in it for a long time, and so I just continue to invest in it, right? Even though it may not be the highest return opportunity for me, or are you clear again on where are the opportunities? Like I said, it's not necessarily going to a whole new business, right? It could be, this is a whole region that's underpenetrated. Let me really put in resources to scale significantly there. And those resources are going to come at the expense of another area where, honestly, if I look at my return and, relative to my invested capital, it's much lower, right? Yeah. So this ability to dynamically reallocate capital, by the way, we found that for FOBs, as McKinsey, we've done a lot of research in the space, and we found that it holds across the board, right? The best performing companies reallocate capital much, much faster than the others.
Okay. It's really interesting to me, and I think it speaks to the importance of working on your business and not getting sucked into the whatever the work of daily activity. But thanks, Ach, I appreciate you mentioning this.
Got you. So the third is this whole capital efficiency and operational excellence, right? So remember, you go to the next page, you remember when I started, I said, typically the FOBs outperform in the early days by being better investors, and then over time they become better operators. Right? So the best are able to do both at the same time, right? So they maintain that edge on being a great investor in terms of the returns that they can deliver for every dollar invested, but they also are great operators, right? And that's why the diversification works for them, because through, as the better investors, they quickly identify where else to expand into, what are the regions, what are the products, what are the channels, whatever it is, right? And they're very good at making those decisions and going after those opportunities, but they're also really efficient at running the business, right? So the best are good at both, right? Again, that's the question I'd have for you all is, where are you on that spectrum, right? How good are you in terms of, running your business and how good are you in terms of identifying new opportunities to go after. And then the last two, I think we bundle, so it's, talent, right? So, and governance, and you'll see some of the, findings we had on the next page is on the talent, it's all about, the best invest a lot of effort and time in identifying the talent, but in keeping them. So, we did a case study on LVMH, and you can see, the talent retention is incredibly high. A lot of the in management and the teams have been there for 20 plus years, much longer than you'll find in other companies. And that's because these folks, again, this purpose, they live this purpose, they breathe it, they feel like this is their business, right? They don't feel like they're just working for that company. And it's very, very different from just a traditional non-FOB. So it's ability to really identify, attract, retain exceptional talent. The best FOBs do really well. Then on top of that, they combine that with really strong governance. So on the next page, you'll see some of what we found in terms of outperformers, in terms of governance they put in place, right? So, documentation, formal documentation, forums that meet boards, right? Having a board in place, and actually having non-family members involved in making decisions. That doesn't mean it has to be professionally run. It can be professionally run, but that doesn't mean that it has to be that way. But even if it's not, how do you make sure you also get some views from non-family members when you're making these decisions? That's very, very important. And we've seen the best FOBs do that as well. And of course, how do you put training programs in place for the next generation, right? So they have very formal governance mechanisms. And when we spent time with the next gens in Zurich, that was a big question. Some of them, the companies had been for 50, 60, 70 years, and they still, barely had a board, and it was barely properly structured. And those are conversations we're having. So the best performing ones really structure it very properly, and they have a strong governance in place to deliver on these results.
I think
so that, sorry, you're going to say something, Dan?
No. I was just going to say, I'm glad you shared that because, when I think of McKinsey, I think of one of the most prestigious consulting firms in the world. And the types of people that would be drawn to that would be very prestigious, successful companies that you would interact with. So then when you're telling me that you spent some time with a group of next gens that, didn't even really have boards put together and some of what I would call more basic family business governance. It's great to hear that is part of your ecosystem, because it's certainly part of our ecosystem is that type of so anyway, I'm just glad you mentioned that.
No, and we've changed a lot. So we serve a lot of even smaller companies now, and on all these topics we were just discussing, right?
Yeah.
Helping on the because it's a journey, right? It's a journey for many of these businesses. So that's, again, this is the journey. So as you think about it, and this is the work we do for our clients in general, when we help them think through, how do you become an outperforming, family business, right? So start with, of course, it's always embedded in the purpose, right? What's my purpose? What's my aspiration? Then let's understand your starting position and be very, very granular around how you are performing today, right? Because usually you start at a high level, yes, I'm making money here, I'm not making money there. But when you're really, really granular at a segment, a product, a geography level, you'll be very surprised by areas that are, because you're making money in some areas, they completely mask inefficiencies in others. So we get to be very, very granular from a starting position. Then we start to think about, okay, what is the way forward? So how much more can I optimize my current business, right? How much more, both on the top line, but also on the efficiency side, right? How much more can we optimize that? What are areas, as we talk about, what are the trends I'm seeing, and what are the trends we are seeing around these different spaces we're playing? And are there areas where we're saying, we're making good money today, but honestly, if you project for the next 5-10 years, it's probably not going to say this is the right time to actually exit and go invest in something else. But the question then is, what else do you want to go invest in, right? So what are the new opportunities?
Right.
And then there's, it has to be, again, very fact-based and grounded in data around what's opportunities. Am I the natural owner of that opportunity, or am I not? What skill sets and expertise do I have and capabilities do I have to really go after this opportunity, right? So that's the fourth thing. And then beyond that is all the enablers, right? How do you make it happen? We talked about capital allocation. So how much capital am I going to need to go after this? Where is it going to come from? How am I going, is it going to come from? What should I prioritize? Talent, attracting and retaining the right talent we talked about, and putting the governance in place. So that's generally the process you go through. And just the final page I have here is for the companies where we've done this, and the companies in our sample, people who did this right, you can create 4 times more value, over in a five-year period, right? It's huge opportunity in terms of value creation when you move from one quintile to the next if you get this recipe right. So let me stop there. Those are just findings. We're going to happy to share the full report with you, but happy to take any questions as well.
Yeah, I got another question that came in, Acha. So, kind of related to your work with family-owned companies, and maybe it's a little more, this one looks a little less specific to your research here, but more anecdotal to your experience. Is that, what do you see that, the best what do you see that family businesses often get wrong when you're working with them, that, is something that you work with them to avoid, that seems like a common one?
Oh, wow. I mean, there's plenty, but
Okay.
also there's plenty that they get right. I think it depends. The work on governance for us is very much what we talked about, which is, we work with them to set up sort of, the proper governance models in place to make sure that they can perform and sustain themselves over generations. Martin is going to talk about stewardship, right? So what they get wrong there is, it typically is the patriarchs and the matriarchs, and they just don't have these governance processes in place, and it's starting to hurt them, right? So that's one area where we help. Another
Okay.
area is about just the core business. It's about, the business is doing fine, but it's muddling through. And the question is, how much more can I extract from this business, right? And when you've been in it for a very long time as a family, and people are always just listening to you, you don't always have other people bringing up interesting ideas, right? So we usually come in from the outside with some fresh perspectives, work with the teams internally to figure out, how to basically turn around and transform the business. So that's the second area. The third area we're doing a lot more work now is, again, based on this work, on this research, is this sort of diversification, business building, right? What are the things we want to go build? So as McKinsey, we do a lot of business building with them and say, fine, let's go and identify the next, set of opportunities for you to go build, and let's actually partner with you over a 2-3 year period to go build that business, right? Where our incentives are aligned with yours when we go build. So that's sort of, a third area. The fourth area would be everything on the operating model, right? Which is, the structure. Do I have the right structure? Because sometimes these family businesses tend to grow very, very fast, but the structure hasn't followed through. So I just had another conversation with one yesterday, actually, where, I'll say it's like a kid who's grown too fast and the pants are too short, right? Because the structure has not kept up with the growth, and the growth is there, but then this is now starting to get in the way, right?
Yeah.
So the question is, how do you put in place the right structure, processes, attracting talent, and all of that to make sure that we can actually sustain and accelerate our growth, right? And so those are just a few of the areas we've been helping our clients on.
Okay. I appreciate you mentioning a couple of those. A lot of that gets to thinking strategically, and now I got a couple more questions coming in too. I'm sorry here.
That's fine.
One is on governance, and I know we're going to talk about it more with Martin, but you mentioned governance. Founder Frank, I call him, he's is got the company going, and he has his kids involved, but probably no governance, or close to no governance. And then that third gen isn't that far behind. But what are those things that you're talking with that first gen founder about, as far as some of the first things within the governance umbrella to start deploying, to start putting time into, and how do you convince them to put time into that?
Yeah. So first, I think they start with convincing them, right? Because generally they've run the business, it's done well, right? They haven't had to have a board, they made decisions, and they're like, why change?
Right.
And so the first is convincing them. And generally what we find is, as they grow older, and they, usually there's an inflection point, right? Whether it's they're trying to sort of pull back more, they're trying to bring in, the younger generation into the business, or, they need to attract, bringing external capital, or they need to list. We feel like usually there's a trigger point that forces them to say, okay, yes, I've been doing things in a certain way. Should I do it differently? All right, that's one. Or two is just, and this is just spending time with them, right? For many of these clients, it's you just spend a lot of time with them and gain their trust and gain their respect. Then eventually they'll listen, and you raise it once the first time, they dismiss it, and you raise it a second time, and then eventually they're like, okay. And then they start to hear it from enough people. The bankers are telling them the same thing. Potential investors are telling them the same thing. We are telling them the same thing. So they're like, okay, maybe there's something that I should explore, right? But it's a journey to take them to take them to that point. And then Wednesday, in the space of, okay, fine, let's go and explore it. It's okay, fine. You have to understand, how far do they want to go, right? So, I know my clients in North Africa, it took them a long time to decide to actually bring in private equity investors. People were knocking at the doors forever, right? But they were just not comfortable, right? They were like,
Right.
we like to run our business. We don't know these people. Eventually, they did, and they're very, very happy because this is actually, propel the business to another level. Right? Or in some cases, like, I'm happy. Let's start with more. Let's put sort of the family council together. So in terms of how we as a family run and make some of these decisions. In some cases, it's okay, fine. I've been running the business. Let me actually set up a foundation. I've been, doing some good here and there, but let me actually set up a foundation. Then it's okay, fine. You know what? Next is okay. Okay. What else should we do? Let's probably set up a family office, right? To now go and invest and look at, not just this business, but what else? How else can we, invest, sort of our hard-earned money and to make even better returns in something else, right? And what else do I have exposure to? So it's all of that, but this is a journey that we go with our clients down.
I think that's important to remember, is it's not just going to be one conversation with somebody that's going to make them flip the switch to want to put time and effort into some of these things. It's going to have to be multiple conversations. Some of them aren't going to go that well, and it's going to have to be multiple folks oftentimes that are saying it from different points of view, different parts of, like you mentioned, their bank, their attorney, their tax advisors, whoever else might be a competent to them. So a couple more questions here, Acha, and I know you have to get going. Any example company that you could kind of, I don't know if there'd be one like that might be a bit more public. I know you did a lot of research with publicly traded but family controlled businesses. Any example companies that you could kind of point to that might be kind of a North Star, so to speak, for firms to look at and say, they've got it going on, they're doing it right, and how they're approaching these 9 elements?
Well, I think the quite a few, and Martin, I think, is going to talk more about his stewardship, right? I don't know, Martin, you're going to talk about the Lego example. If you look at what the Lego family has done, it's exactly that, right? And in a context where they actually went through a tough period, right? But they really came and figured out exactly what are we good at, what are our core capabilities, what do you want to get into, but then how do we then really put in place the right governance model to deliver on that? So Martin, are you going to talk about Lego?
Yeah, we have it.
You'll talk about it. You'll get to it.
All right.
I think LVMH is another one, right? I think the Mars family, Martin could talk about that as well, but the Mars family is, if you want some US examples, that's another really, really good one that, if we think of this value creation formula, that's exactly sort of what they followed.
Okay. And I got another question here too, maybe before we switch, on boards. So we talked a little bit about boards earlier on, as far as you were mentioning, working with these next gens, they don't have a board, or their board is loose or family only. As we start to put in place some independent board members, it's a big thing we talk about in our program all the time, is advisory boards and boards of directors. But what kinds of things do you suggest these families look for in those independent board members? What kind of key characteristics are you helping them try to screen for?
Yeah, so I mean, I think it's, it starts with, why do you need them, right?
Yeah.
And what type of do you need on the board that will be helpful, you know? Um, and so, you know, I'll start there. In some cases, okay, you know, I really, really understand this business, but when it comes to sort of finance and we're in a space where we're going to have to go raise significant amounts of capital, or when it comes to, you know, geographic expansion and we're very US centric, we want to go to Europe next, right? Or to Southeast Asia, right? You know, then, you know, who are the kind of people who can bring that perspectives, or it's, you know, we're very exposed to sort of some of these tariff issues here. We really need to understand geopolitics, right? And how that's going to play out and how could it impact our business. So those are, you know, so I'll start with the, what are you looking for in terms of skill sets, right? And in terms of expertise on the board, and then how do you then identify the people who have it? Now, once you have done that, it's not just people, you'll have a lot of people who know about geopolitics. You'll have a lot of people who know about expanding to Southeast Asia, right? But the question is, how do you find the right person, right? And this has to be, in my mind, especially with family businesses, what we found is you want somebody who's very aligned with how the family thinks. Same thing when they're thinking about a private equity firm, right? Many of my family businesses would rather actually, a client would rather actually get money from some of these PE firms that were founded by families, right? So families in business, and then it's found the PE firm because they feel like, you know, our values are aligned, they understand us, right? So really getting to the bottom of, you know, understanding these people and making sure that they're the right folks for your board in terms of, you know, how they think about business, how they think about family business, how they think about what we talked about here, the long-term perspective, how they think about, you know, your cautious financial stance and all of these, right? So I think so it's let me figure out what skill set I need. But once you've done that, I think even more important is really going through a process and getting many people to interview them and deciding, is this the right person from a fit perspective for our family and for our board?
I'm really glad you mentioned those two sides of it, because I feel like sometimes it can be just you know, you start with the why, of course, and what is our motivation? What are we looking for? And it's usually expertise driven, or, you know, experience or connections or whatever. But that whole fit piece and alignment with what our culture is as a family is equally, if not more important. And I can tell you, I've worked with a ton of family businesses to be able to rattle that off as quick as you did, and to know that so stone cold, frankly, Acha. So I really appreciate you mentioning that. And I'll let you guys keep going.
Good, thank you. So that was me. So thank you very much. I hope you found this helpful. You know, we'll get to the article and you can share it with the group. And if, you know, you all want to talk about it, you want us to do a similar presentation to your teams and those kinds of things, we're very happy to discuss that. Let me hand over to Martin then, who will take us now to the stewardship presentation.
Thank you, Acha. Thank you very much.
Fantastic, Acha. Thanks so much. So we thought here for the second part of the webinar to focus a bit on stewardship and building on some of the points that Acha just made. What is quite interesting about family firms is there's this great quote by Johan Andresen. He's the fifth generation of a Norwegian family office. He came in 1998, and he realized that he wasn't very passionate about the assets that they had, so he sold all of them and built a fantastic family office. And he said, we can be impatient for a very long time. And I think it gets to the crux of the issue. What about this asset class called the family business? What is the secrets about it? And you heard a lot from Acha and the research we have done. So family firms are very nimble. They're super competitive, but at the same time, they can do it for 100 years. And let's start with the first generation, second generation. But in Johan's example, you can actually do that over quite some time. And I think that kind of illustrates very well what family firms are all about. They have a long-term perspective. Acha talked about purpose, but at the same time, we work very hard every morning. We go to work, we fear the competitors, and we're going to renew the business. So a very good quote to kind of start on that part. So what is stewardship really all about? It's kind of much talked about. And the way we see it is, it's really how do you, almost in your generation, how do you take on the business, the shareholders, the governance, the voting structure, and how do you actually pass it on, hopefully in a much better shape than when someone took it over from you. It's also the perspective, if you have founded the business or it was founded by mom or dad or uncle, how do I actually set up certain structures so it can actually outlive myself and the generations to come somehow. And today we're just going to break it down into 5 different elements to get you thinking. Happy to take questions and we'll discuss it as well. Purpose, ownership, governance, succession, leadership, and kind of renewal here. First of all, purpose and family capital. And capital is not the kind of the currency that Archer talked about, the US dollars and the multiples and all that, but it's more, what do you bring? What does a family bring to the business? What's the positive side of it in terms of values and the legacy, this very long-term view that we just talked about, but also something which is linked to the family identity. And I'm pretty sure for many of your businesses, it is linked to your family. You are known in the neighborhood. You are known among channel partners. You've been around for quite some time. There's often this culture around family firms. I like the family, that they take very good care of me. I like to be in the company because they're somehow present. I may not work with the CEO or the daughter or the 2 cousins all the time, but in the end, I actually trust them. And many pieces of research have found that trust is a huge thing when it comes to family firms. In the end, why they do so well and what they bring to it, why would I like to work with them or do business with them, is because I trust them. So trust comes with that. But of course, trust can also be, you can squander trust, and you see a lot of the negative sides when it comes to family firms on the right-hand side. So knowing where we are heading on the purpose and we are the family behind it, it's also important to look at ownership and governance. And these are super, super important points. And you can take the example from Wallenberg, which is an old Swedish industry conglomerate based out of Stockholm. They were founded in 1856. It was originally a bank called the SEB Bank. And now you are here with Marcus Wallenberg, and they are 5th generation now coming into the 6th generation. The interesting part about Wallenberg is that no one owns the shares. It all sits with various trusts. So as you see here with Wallenberg, we don't really fight a capital. We can only develop and allocate the capital, as Archer mentioned. So Wallenberg does quite well. But it's really about finding out, how do you structure ownership? You're really going to find out about, is it trust? Is it this kind of public-private? Archer talked about having private equity. Are we going to have leverage from the outside?
Mm-hmm.
How do we control it? It's easy when you are the original founder. Maybe you work with your husband or your wife or your brother, but as you can imagine over time, this is something that's going to escalate and we need to have a plan for it. And a big question is always, you see that in, who's going to succeed in shareholding? Is it the firstborn? Has it be equal, or should it be the best one? And put yourself in the shoes of uncle and mom. It's super yourself. How are you going to pass it on to your kids or to other shareholders, other family members? How do I make that decision? Many families do not have a plan for ownership. And we do recommend to think about ownership early on. It doesn't have to be a plan which is set in stone for 100 years, because it has to be fit for purpose, but find out about what is fairness in terms of passing on the ownership and make that kind of judgment. For example, if you split ownership in 3, imagine some founder has 3 daughters. The middle one is going to go in. She's a very capable one. She will spend 20 years with the business. The 2 other sisters are not involved. We have an issue called fairness. Maybe not at the initial set. She might be early 30s. She takes on maybe the CEO post. She works very hard for it. But she's also the one that's going to give her life to the business. The 2 other sisters may not even sit on the board, but they are actually picking back in and they are benefiting from that shareholding. You're going to decide as a family what is fair in your family. Have a plan for it before it actually gets into conflict and it kind of infects on the family dynamics and so forth. And then a lot of other technical things on voting rights. But all in all, have a plan for ownership. And I know it's tough to talk about money. It's tough for next gens to walk in and kind of ask mom and dad and uncle, what about these shares here? Because in the end, are we really working for the money, or is it something higher, the purpose and the legacy and being part of the family? Of course it is. But on the other hand, I am also, as a next gen, potentially going to be part of this for a very long time. So this tends to evolve over time. On the left-hand side, we have a very simple system, which is what we call a owner-manager. But of course, as you evolve and you become more mature, you start to think about, how do we kind of split day-to-day operation? How do we set up governance systems? What about the shareholders behind it? And even at the top level, how do we structure the family somehow? And of course, families, businesses, it comes in all shapes and formats. The point is here, as you evolve over time, we had that conversation, Dan, just before we got started. What characterizes family firms, is it really the size of it? It's probably more a timeline. Of course, it's an aspiration, but it's also a timeline for your appetite and what is right at a current time. So how fast would I move from the left to the right? It really depends on where you are as a family here. Don't overcomplicate it, but also make sure on the other hand that you have a process in place for it, some rules in place, because otherwise we might get to some of those conflicts that we often hear about. We talk often about above the house, top of the house, and within the companies, just to think about how to split governance in family firms. On the upper left-hand side, you see Family Matters. Archer kind of referred a bit to that in some of the questions here. Have policies for how do you keep together as a family? What's the policies for family? What makes up a family? Can in-laws be part of it? What is the values that characterizes us? You often have back in the founding family, you have, values and legacy and why we exist, but also on the right-hand side, have rules for shareholding. Make sure you have those things in place that we just discussed. And then, of course, when it comes to the corporate matters, where we move a little away from the family side, we get into the corporate side to the business side. Make sure we have boards and have that kind of governance that we just discussed before. And then, as you heard from Archer, when it comes to kind of capital matters. So kind of above the house, which is more the blue box, the family level, the shareholder, the people behind it, the board holding and the governance, and then, of course, one or more businesses. And you heard from Archer, whether you are divesting and you are acquiring and you are basically renewing businesses over time. So that's the second one to think about. And we know this.
I got a question, Martin, that came in on that last slide there as far as family matters. So one person's asking a question about, do you see families that change a little bit in their policies over time? Or are those fairly stringent to the families that do well? But can they adapt over time as generations change?
They definitely change, and you would say in the beginning you rarely find policies because this is based on maybe the first. It's often within the first, second, third generation that you start to have policies. Often you have unwritten rules, you have preferences, but it may not be put on paper. What is very important in the early generations is to have rules for it. Rules for participation, what contributes to family, family council. How do you structure governance kind of within the family, right? And of course it has to change over time. We actually did a project in the US last year with a G1, very successful entrepreneurs, built up a fantastic big business. But now the time was to onboard the 3 children. And the question was, what type of role? Should they work in the business? Should they be stewards? Or should they just be owners? And that was really a discussion about what is the role of the family. So we set up there in the upper left box. So you need to have rules for that. Don't overcomplicate it. Often you have what we call family constitutions, and they can be quite big. But start early somewhere. The most important thing is not the final document, but it's actually the discussion in the family, what you can agree on. And then you can put it on paper, couple of pages, 10, 20 pages, where you stipulate some of the necessary thing, and then you maybe revise it every now and then. So have a plan for it, super important.
Okay, I appreciate you saying that. The journey is the destination to some extent. Okay, thank you.
And then the third part is succession. And that can be the very tough part of it, because how do we actually pass on the business from one generation to the next one? In the bottom one, you might have referred to owner managed sibling partnership and cousin syndicate, but we start in the beginning in the bottom with one or several owners. Here could be 2 cousins, 2 brothers, whatever, which is very much the entrepreneurial founder. But as you see, as you go into generation 2, what characterizes a sibling partnership is that the siblings live under the same household. So you somehow get that apprenticeship from mom and dad, sometimes your uncle. But when you get to the 3rd generation, we start to split into various branches, and we get what we call a cousin syndicate. More family members, maybe more requirements to pay back to the dividend question, to serve some of those shareholders if they do become shareholders. But people also start to divert in their mindset. Because when you grew up with your siblings, as much as you can be super different, but of course with cousins, you did not have the same apprenticeship. Imagine you have two brothers that founded a business in G1. Each of them, one had 2, one had 3. Now you got the power of 7, and when you get to G3, who knows? They will be very individual personalities. And this is where the rule-based system has to come in, because you can't just, first of all, you can't sit around the same dining table, which you do in G1 and G2. And this is where the complexity is. So you typically see the need for governance, but also the way to govern succession when you get into G2 and G3, because you're dealing with way more family members compared to, let's say, from G1 to D2. And of course, it's cultural dependent. Where do people get kids? I don't know, the US, maybe 1 to 2 kids, but you got regions of the world where I get more kids because that's simply culturally accepted, or it's a custom, or it's a proof of success and all that. But you simply need to have rules for more members. And the question is here, you're not going to have 5 or 7 CEOs from the same family here. The question is, who's going to play what role here? So
it's a big point there, as far as that G1 to G2 looks so much different than G2 to G3 if you're continuing to hold several branches of the family as involved and as owners, is they no longer
exactly, and you could potentially see values start to drift a bit, or start to just to ride a larger diversity. Back to Archer's point about your core asset, your core industry, maybe my preference is to, I want to go into retail, I have a preference for B2B, I want to explore technology, which is only natural because you're dealing with different people. And therefore the rule of really having governance, but also have a very clear succession plan, because you're going to have more people potentially expecting what is going to happen. And therefore super, super important to have that in place.
Yeah.
The reason why that is so complicated is, and we always see succession maybe used to be a one-way street, but I think we need to view succession as being like a dual street and having 2 protagonists. We heard the cases back in history where, I finished my studies in the London Business School, I started at Harvard, and then dad or mom just expected me to come back. That's kind of the classic succession story, and many family firms do not have a succession plan. But I think also with newer generations, there is an expectation about knowing, where do I fit in? First of all, is it something I want to do? Secondly, am I capable and motivated? And could I potentially, I wouldn't say give up my life, but could I dedicate my life to actually be the one in the business somehow? So the question on one side from the predecessor is really this, what we call the willingness to pass on the entrepreneurial spirit and flame. We shouldn't forget that any successful family firms, even the outperformers that Archer talked about, they have very good entrepreneurs. Whether you're a 5-person business or you're a $3 billion, it doesn't really matter. You got entrepreneurship. And the big question is here, can you pass on entrepreneurship? Do I have that desire, motivation? Can I take on that burning passion for entrepreneurship on the successor side? And of course, I might hold back on the left-hand side because I'm going to step it out. I'm going to step down for power. There's something about legacy. I have the control of it. But when I pass it on to the successors, I also need to see successors, they need to have room to operate. They need to be able to renew it a bit, do it their way. And therefore, you often see this kind of conflict and the tension between the two. There probably will always be tension, but I think the point of this chart here is to really make sure that it's a dual process. It's not a one-way street, mom, dad, uncle, auntie deciding. It's actually a conversation about potentially succession now, medium, and kind of long term. Really trying to observe that there are 2 parties, and both parties should sit at the table and be involved in succession planning. There's a lot of great work done by Professor Edmondson from Harvard Business School about psychological safety, and Amy actually studied psychological safety before I think it became a bit of a hot topic. Psychological safety is something that we have talked a lot about on a global level the last, I would say, 5 or 10 years in terms of working cultures, team performance, cultures in corporates and all that. But it's also a super, super important thing when it comes to family firms, to have that psychological safety. We might even in the succession process agree that we disagree. But once you have psychological safety, diversity of views are welcome, because we're going to find out about what is that succession plan going to be all about. So it's not a blame game, but it's actually observing that we are different souls, different personalities, different genders. We have different outlook in life. What holds us together could be blood and family line and my name. I come from the same family, but we need to observe that people are different. And I think the families that do that have a much, much, much better chance of doing that. We mentioned LVMH before, and I think this is, some of you might have seen Succession at HBO, and if you haven't
sure.
seen it, go check it out. Fantastic. You might have used it in your teaching and classes, I'm sure, but
We do,
absolutely
yeah.
fantastic. Maybe not too far from reality, I don't know. It's a bit exaggerated, of course, it's Hollywood drama. It's beautiful drama, but think about, so there's probably a case here which is bigger than Succession, which is LVMH. Bernard Arnault bought on the back of Job LVMH in 1984 and 1987 and created a $400 billion market cap business in the first generation. He's now 77, if I remember right. He has just extended his run rate to 86, which is approved by 99 point something of the LVMH shareholders. It's partly listed, but they control the vote. So they want Bernard Arnault to continue. So he's still a first generation entrepreneur, but he has also, as Archer said, built an incredible M&A machine, and he's very, very good with talent. Now, the interesting thing about Succession is Bernard Arnault has 5 kids, 1 daughter and 4 sons, all capable, all working in the business. Tag Heuer, one is in DFS, which is a wine and spirits. One is working in the family office. One is in Louis Vuitton. One is in Christian Dior. As you know, LVMH bought the famous Tiffany, and they sent Alexandra, who's the middle son. He was actually seconded to New York for a few years. He just returned to Europe to continue in wine and spirits. So the kids in the second generation are also very well trained. The question is here, we don't know it because it is very well guarded. Who's going to be the next here? There is Bernard Arnault as CEO and chairman. Question is, what are you going to do with the 5 children? They are both very qualified, very seasoned. They got shoved around in this huge portfolio of different brands. But the question is one day, who's going to lead the business and what's going to be the role for the different family members? I would say watch out for LVMH and the succession here. It will happen, if not now, at least in the coming years. So super interesting to have a look at.
Yeah, we talk about that case a lot with Louis Vuitton, and the Journal here in America and the New York Times did 2 big pieces on that family. Very interesting pieces through interviews with family members, et cetera. Kind of you can start to see some of the same tensions and conflicts that would affect any size company, right? In that first gen to second gen movement. So yeah,
they started they started very early. And one thing which is very guarded because the family doesn't really talk. You can speak to Bernard Arnault, you can speak to the family about business, and they will love to comment on Christian Dior, the outlook of Louis Vuitton and luxury. Of course, they will, skincare, cosmetics, and they're very good at it. But it's heavily guarded when it comes to the family. I would say almost nobody knows about it. It's a lot of speculations, but it's very hard to assess what that is. But I found it incredible that you, in a span of, he started in 1984, and now you are here some 40 years later, and he has built like a 400 billion market cap machine. This is incredible. And as Archer said, on the junior side, but also on very seasoned senior leadership, they are simply a talent machine for younger and for seniors. They have done super well. And they have acquired, think about, back to Archer's point about portfolio, they have acquired a lot of businesses. They have created businesses too, but they mostly have acquired Sephora. They acquired a Christian Dior. That was his first M&A. He bought Christian Dior. It was bankrupt. So he bought it for very little. And you got the acquisition of Tiffany and many different brands over the years, right? And they take those brands further somehow.
Yeah. They've done a great job of folding kind of some tired brands into their lineup and livening them up.
Yeah, they're super good at it. Multiple M&A work. Then it's also about who's going to lead, maybe to the LVMH point, who's going to lead the business. And I think here is an important chart just to think about, because part of that challenge for success in a family firm is really about having a plan for roles, and roles can change over time. And why is it important? At the top one, you're a family because you are born Smith and Jensen and Duke, but that doesn't give you any shareholding. You're part of the family, but the question is, how do we maintain family harmony, unity, and cohesion? So you are a family member, but over time, what role should I play? And you can play 3 different roles. First of all, you can probably play the role to just be a family member, and people decide to work outside, to decide to take on a different career. I had these conversations. I met more than 750 next gens all the years as a mentor, partly at business school and outside in the client work we do. And I get that question all the time. Martin, should I work in the business or should I kind of work outside? The same question, of course, goes for very senior leadership from the family or from the outside. Should I be an owner? Think about Howard Buffett is now going to succeed Warren Buffett as an owner. Warren Buffett is not an operator. He's not heavily involved, but he owns assets. I'm going to get back to the case about Lego later on about being a steward. So steward is being an owner, but it's something more than that. It's kind of the safeguard of the purpose, of the values, hiring probably the right leadership and so forth. And then, of course, you can be very actively involved as an operator. So think about when it comes to roles for yourself, other people in the family, even outsiders, what type of role should they have? Even a discussion is here, which I'm sure is a discussion you also have in class in your circle here. What about in-laws? What's the role of in-laws? Should we be involved in this work? Can they become an owner? Can they be a steward? Can they even work in the business? And you also saw that in the succession series, right? Which can be a big point of contention here and could be a discussion point.
Absolutely.
And then the big question is here, the pros and the cons. Question is, when we're going to appoint leadership, on the left-hand side, should it be a family CEO and or board member, also on the governance side, or should it be an outsider? And of course, there are certain advantages in the upper left because you are from the family, you live the emotions, you have the name. We don't have what you call an agency problem because I'm actually acting hopefully at the best, in the best interest of the family. Whereas if you have professional outsiders, can we really trust that people are really clear of those biases and this kind of maybe short-termism that you might see from outsiders? So once families, over time, it may not be in G1, but over time, Bernard noted that already in G1, had to decide on outside leaders. I mean, because Emily MH was early on very dependent on professional outsiders because family simply is not too big enough to take on the roles. So whether you're G1, G2, or G5, or whatever, doesn't matter. You always have this conundrum between family members versus non-family members. And it speaks to the considerations before your daughters, yourself, owners, stewards, and operators versus family here on the left-hand side, the pros and cons versus professional outsiders. And there's no right or wrong issue. I mean, obviously talent is always a big part of our research, but you really need to think about what's the best, is it fit for purpose in our business, and go through some of those challenges that you find very often. Who's expecting what? Would I like to be in the business? Am I capable? Am I rightly educated and so forth? On the other hand, if you go on the open market on the right-hand side, I can actually hire people. I can go and hire from competitors, from the market, and I guess find some of the best people you can buy for money. How do they compete with family members?
So we have a question that came in on that, anonymous here, but how do you walk a family through that, what could become a major tipping point of change, from family managed, family controlled, family decision making, to somebody else in that chair, and it's a big decision for a lot of our families.
Mm-hmm.
Them come to it kind of, I would say through science. Like the parents are getting older, they don't want to do XYZ anymore, and the kids just aren't old enough yet to run what is now become a very large, potentially anyway, a large sophisticated business. How do you walk a family through those conversations? Because you're going to get a lot of different viewpoints.
Very good question. It's complicated, but it's also super important. I would rig it as a journey. I would not see it as like 2 workshops and then we decide. It's really a journey. First of all, I would really start to understand the dynamics of the family. I would understand, as you maybe refer to, the aging generation. We might be in our 60s. It's time to pass it on to someone, but we have always led it and owned it ourselves. Kids are not old enough. Really try to understand what are the pros and cons of having an outsider. What is really your dream? Would you like to see your children one fine day to be part of it? There should maybe potentially be a placeholder in the meantime. But of course, the first outside hire for boards and or leadership CEOs is always going to be super, super tough because you're going to relinquish a bit of control and you don't want to completely over micromanage the person that you get in. I would have a discussion about competence, about desire, what is the risk of it, And also, how do we put the right governance structure? You can't just let loose an external CEO. Of course, you need to have some kind of a governance mechanism, whether that's a more or less formalized board. How do we consult the family? And how could I maybe gradually over time, as a 60-year-old, realize that I'm stepping aside, or I'm actually pulling it over in the hand of the professional outsider? So see it as a process. Do the due diligence, but of course, that sooner or later, people are going to take the plunge to do that. There could also be people internally in the organization that could be taking over in a great way. But as you see from this chart here, and it's deliberately very rich, there are a lot of pros and cons.
Yeah,
And
absolutely.
of course, you want to tick all the boxes here, which I guess is impossible. But you probably need to come to the realization that at some point in time, the larger you become, families, most businesses would kind of, outsize the families, or there simply is a need for a professional talent bench.
Okay, can you touch one quick question here? Agency
Sure.
problem, that's a conflict of interest topic there, but could you just clarify maybe what you mean by that when you say that in here?
When I run agency is really, how can you trust other people? Because if I'm a family member and I'm the daughter of my father, I am supposed to be much, much closer to the values, to transparency, to responsibility. Whereas if I, for money, hire someone from the outside to do it, can I really trust that person? Would he or she run away with a checkbook? Would he do something which is not in our interest? Would they be there for a very short term? Because think about the kind of the tenure of CEOs and leaders is probably shorter, because family members often serve for life. Whereas if you're a CEO that is hired from the outside, rightly so, they have careers. They don't come to work for your family for life. Many of them do, but they might leave after 3 to 5 years because they got a better offer in another state. It's super normal. But would they then act very short term? Do they actually act also in the long term that goes beyond the paycheck, beyond the bonus scheme? And that's what you call the agency problem.
It's a big one. I mean, in terms of how are they treating capital? How are they looking at performance? Absolutely, their allegiances are different. So thanks for expanding on that a little bit more.
Yeah, and it's a bit related to nepotism, because I'm not saying you need to have family members and then avoid agency, because you can also have the other problem, which is nepotism. And it could very well be that an outsider is cleaner, more transparent, more capable, more professional.
Yeah.
But then you're going to find a role as an owner, as a steward, and not run the business.
Right.
Back
So
to
do
the
we
point.
want the dumb son that is loyal but isn't going to perform very well, or do we want the amazing
Yeah,
outsider?
and sorry, and also the typical, as Archer said, when you trim or you expand your portfolio, you might go into an adjacent industry. That may not be an industry where we have competence, because we have been in F&B for many, many years, but now we're going to go into some industry. It might be better to hire an outsider. So there could sometimes be a very practical discussion to say, we bought this company, but we need to hire for competence because we don't have that competence within the family. We don't desire to do it. Let's hire someone or keep someone in the company that we acquired. This is where you also get that discussion in.
Yep.
And then the last one is renewal, and kind of Atja talked about it, and I talked about the entrepreneurial spirit. And a very good example, many of you might have heard about Lego, the old Danish toy firm. It was established as a wooden toy firm around 100 kilometers from here to the very west, 150 kilometers west of Copenhagen, where I'm currently calling in from. So Lego expanded, came into plastics, and built the modern Lego that you know about. Some 20 years ago, Lego were in trouble because they probably have, first of all, expanded into adjacencies, theme parks and clothing and all sorts of things, and maybe have kind of had forgotten a bit about what Lego was all about. And deep down, Lego is a toy business. And what do? They motivate and inspire kids. But they have gotten too far from the core, probably forgotten a bit about the NDA, the DNA of the business. So what the third generation chairman, Kjell Christiansen, that you see here in the middle, the grandchild of the founder, he actually hired the first non-family CEO from the outside. Jørgen V. Knudstorp, he came from McKinsey, and in the span of 10 years, he went in and he actually turned Lego around. And the way that he did that was through research, through a very deep understanding, not to something Lego didn't know about, but they probably had forgot about it, because their toys, their products is super, super good in inspiring people, in motivating kids' creativity. And who knows, one day that person might go and study and Stanford, become a PhD in technology, whatever. So you want very early on to kind of inspire your kids. That's what Lego exists in the first place. So the first CEO kind of reminded the family about that. And now, as you see, the second CEO has now actually taken on here. Now, back at that time, 20 years ago, because the third generation chairman has 3 kids, 2 daughters and a son. And back at that time, the children weren't really interested in Lego. And back to our discussion here, who should lead Lego moving forward? They decided to have. You said that, but back at that time, Lego were challenged. They wasn't doing very well. Probably a lot of stress and burden on the family shoulders and all that.
Sure.
But what happened is they decided, I think it was a brave choice, to get a professional CEO from the outside, later the second one. But over that time of transformation, of getting Lego to a much, much better place, the children actually decided to step up. And what they have done today, as you see here, Thomas Kirk Christiansen, that you see on the right-hand side, is the 4th generation, the son of G3, along with his 2 sisters. They have decided, back to the roles, that you have one active owner in each generation. So Thomas has now become, because his father, G3, has stepped down, he also has relinquished ownership. So the kids are now owning Lego, split in 3. Thomas has taken on the chairman role in the Lego company, which is the operating company, which I'm going to show in a second. And he has also taken on the role in the family office. So he runs kind of, I would say, the family governance side that we talked about, the holding, but he also controls the board of Lego. And both the family office and Lego have 2 different boards. So he's the chairman of both, but the board is composed of different people here. So what it's really about legacy, and it almost like encapsulates stewardship, right? So even though you face a crisis that Lego did some 20 years ago, because they probably had become a little too widespread, they have kind of lost the understanding of the DNA. They had done too many things at the same time, which was non-related. They got rid of all of that and got back to the basics. And on the basis of that, they fast-tracked into, they actually run one of the most valuable family offices today. It's probably one of the top 15 family offices worldwide. They have a lot of wealth. And they have done it very well from the core selling of Lego, and I think they haven't stopped in any way. But they also fixed, remember we discussed the role, family, owner, steward, and operator. Thomas and his sisters, their family, they're all owners. They have split ownership in 3. And Thomas is now the steward. The 2 sisters, one of them has joined him on the family office board. On the Lego board, the operating company, he's sitting there as a chairman, and all the other ones are professionals, outsiders. So you see the family over a span of time have found out, where do we belong? Where do we belong? They have decided to be stewards and not operators. Thomas is not, he's not leading Lego. He's a chair. He leads from the vantage point of a board chair. So I think when you look at successful, to kind of sum it all up, successful family firms, I think it's really about balancing past, present, and future. It was definitely the case with Lego to reinvent the future, but they have to go back in the history books, the old packaging, to kind of realize that the DNA was hidden in plain sight. So I think very importantly, over generations, it doesn't mean that you need to become historians, but you also need to understand where we come from, the legacy, the values. You go back to the Mars family created by the first generation of Mars. There were very, very strong family values, and you still see those values embedded in the company. And that's really what makes up super, super strong families. So make sure you have this kind of stewardship, have succession as transformation, which is also, wouldn't say an excuse, but an opportunity to look at ownership mandates, business strategy, governance, and all the likes of it, along with very strong governance as well. And then think about the leadership bench. Should it be family? Should we have non-family members in business units, in the leadership team, and or in the board or the holding company? And then be willing to learn simply from best practices over time, because there are a lot of good cases here. And I can understand from your part that you also discussed a lot of that in your teaching and in your discussions here. So look at what other families have done as well.
All right. Well, this is awesome, Martin, and we're kind of coming up on our deadline of time here. So while I feel like we need to stop for the day, process some of this. I know I'm going to go back through some of it myself, and I'll be putting together a little bit of a lessons learned myself of what I came away with from this, and sharing that with our audience. just greatly appreciate your time here with us today, Martin.
No, you're welcome. Big
Not
pleasure.
well.
Wish we had more time, but it's an ongoing discussion. So
It is. I hope we can have you back, to be honest with you, maybe cover one of these things in more depth, or
I would love
more
to.
on your strategy with governance with families. I think it's important and so powerful to have McKinsey here with us today. So we're grateful to you, Martin and Acha, and your entire firm really for their findings. So thank you very much. And as I close here, I'm gonna read off some things or I will forget them totally. Two quick things. Monday, June 23rd is National Family Business Day in Iowa. So that's already coming up next month. We're working on a proclamation for that, and we'd love to celebrate that with you that day. Let's see here. And if you have input on topics and ideas for next season, or a conference and other things, send those to anybody on our staff. If you could, we're kind of just finishing up a couple of slots that we still have open, so we'd appreciate any feedback you have. Again, thank you to everyone who was able to participate today. We will share a recording. Thank you so much, Martin. I hope you're doing
My
well.
pleasure.
Thank you very much. Have a great day.
Thank you.